we haven't seen the lag effects. And I want to emphasize this again. We're all flying blind. Every bull, by the way, is flying blind on this because everybody, due to the price action, assumes that nothing bad is going to happen as a result of that. I disagree. It will happen. The question is the when.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. When today's guest expert was last on this program in February, he explained how bulls and bears were locked in a battle for control, with the battle zone roughly defined between 3,800 and 4,300 on the S&P. Well, that battle's now been won by the bulls. On the day of this recording, the S&P now sits just above 4,400. So where to from here? Does the market have a clear path to new highs, or may the bears launch a counteroffensive? To get the best sense of exactly what the technicals are telling us right now, we're fortunate to welcome Sven Henrich of NorthmanTrader back on the program to discuss both his latest macro and market outlooks. Sven, thanks so much for joining us today, all the way from the UK.
Adam, good to see you. I'm glad to be with you.
Thanks. Always a pleasure, buddy. We have great conversations when you're on. I don't expect this to be any different. So thanks so much for taking the time late in your day for this. This should be fun. Lots of questions for you. I know you prepared a lot of charts for this discussion. I know folks can't wait to dive into the details of them. But before we do, just to start off at a high level, what's your current assessment of the global economy and financial markets?
Well, thanks for the kind introduction there, Adam. The global macro and market structure is, in my view, kind of repeating history in many ways. And so a lot what we're seeing right now is not surprising. However, we also are faced with new elements in this cycle, I think, that we all need to be aware of because they are market impacting as well. And give you an example on the macro side, we just had the Fed obviously continuing to raise rates in above 5% now. Yet markets seem rather sanguine about it. And I want to just highlight that is not unusual. This is what we've seen in cycles prior. In fact, markets like it when the Fed is perceived to be pausing. And typically that tends to be initially very supportive of equities. We saw this, for example, in the 2006-2007 period. We saw it just before the 2000 top. So markets traditionally have a runway, especially in the context of now inflation rolling over. I think that's something that a lot of us had hoped for, obviously, and anticipated. And frankly, it was in the math. It was in the math of these extreme spikes that we had following COVID and the supply chain issues. And so you were always going to get lower inflation, frankly, because that's what the math dictated vis-a-vis the year-over-year numbers. What is not clear yet is in terms of the speed in which, for example, you may get core inflation down. That is looking rather sticky at the moment, and I'll talk more about that as well. But clearly the market has a sense of relief, and we've seen that before as well. I think 1982, for example, and everybody's happy and piling back into equities. So the labor market is still holding up, although you can maybe argue a little bit about the veracity of some of the data because we have so many adjustments going on with birth death models and so forth. So it's a bit noisy, I have to say. But for now, the economy is holding in. And you don't have a clear breakdown. Although on the macro front, leading indicators continue to be dreadful on the negative side. We have issues, and obviously in small business confidence, there's a lot of recessionary indicators out there that the market is currently ignoring. We're back into, remember in early February, we were back to the either soft landing or no landing narrative, and we're back to that. And I think price drives a lot of that sentiment. Because as price goes up, the worst is over and everybody's happy again, right? And from a market perspective, what we just seen is not entirely unexpected, but it's also stunning in the way it is unfolding. So let me give you the technicals. First off, when we last spoke, I wanted to give everybody a quick update in terms of how it has unfolded and why it has unfolded, because I think it's really important from a perspective assessment. First of all, when we last spoke, we talked about that battle of control. I talked about a breakout out of a larger bullish pattern. And let me just back up briefly on this. I also mentioned last year being kind of the most controlled bear market ever, because we always saw these lower highs in the VIX. We saw these clean structures. And I was a bit suspicious about all this. And I had highlighted at the beginning of the year that there was never really a bear market, because the yearly 5 EMA always held as support. The monthly 50 EMA always held as support, and the larger trend lines, support trend lines from the 2009 lows to the 2020 bottom, they always held. So bears were never able to break and confirm a bear market on any of these levels. The question then was, okay, if you have these falling wedges, bullish structures, can they play out? Can they take out resistance ahead? And one of the key resistance point was the monthly 20 MA. And we've broken above, okay? And we've broken above and reaching here the 4430 zone. The 4430 zone was a key level for me, because December 20th, I actually put out a chart on Twitter which talked about this potential cup and handle pattern that pointed precisely to 4430. And we hit that last week, actually exceeded it for a little bit, but on both days that it did, it also reversed back below it. So what it tells me is that the market finds the structure of relevance. Doesn't mean a top is in, but it's certainly reflective of the technical targets. That's why I mentioned earlier, when a few months ago when we spoke, 4,300 to 4,400 was that battle of zone control target area, and we got there now with basically a vertical move since June. Now, what happened in the interim? And this is really important. When we had the initial breakout, this was in the February timeframe, then we had this back test, which was important from a technical perspective. Would the back test hold? And it initially did. And we had a bounce from there. So that was all indicative that everything was hunky-dory, all right? But then the SVB banking event happened, right? And everything changed. And this is really important because it leads to where we are now. And it's also important in terms of how this may be going on further. Remember last time we spoke, one of the checkpoints I had, what about at the October lows? This was the infamous Yellen concerned headline. Yellen was concerned about liquidity in the treasury market. This was when the UK Guild was, throwing havoc in Europe. And that was the end of the VIX at that time, right? And it turns out now in hindsight, we know why, because actually from a global monetary perspective, that's when it all stopped in terms of balance sheets reductions. They started, balance sheets on an aggregate basis went back up. This is so important from a global liquidity perspective, because it explains everything that happened in markets thereafter. And the reason I raise that is because guess what? There was a couple of days when the SVB crisis happened, and all of a sudden the back test looked like to fail, and S&P dropped lower for a couple of days. It broke below. And guess what the headline was that came out? Yellen concerned. Okay, which was obviously in regards to the banking crisis that then started unfolding. And guess what they did? They did it what they always do. They intervened.
Yeah, a new funding facility. Yeah.
Hundreds of billions of dollars. First, it was the Fed just basically piling back into the balance sheet. But more importantly, and this is what's explaining all the action we've seen since, because we haven't seen any corrective moves since then, none. It was the change in bank reserve balances. Last year during this, I now call it a correction. During the correction, we had a just superbly clean relationship between the level of bank reserves and what happened with the S&P. When you saw the June lows, that was the bottom basically for bank reserves. They rallied them back up. We got this massive rally in August. We had that even earlier in the year. You know, you can go back and just compare that chart. It's pretty amazing. Tech bottomed on January 4th. The same day bank reserves balances bottomed, and they started raising them in January. And this was all related to Janet Yellen concerns, liquidity, and everything else. So they basically kind of intervened and put a kibosh on this whole monetary tightening piece. And when then the banking crisis happened, they just accelerated that dramatically, to the effect that now the net effect is $500 billion added in the first 6 months of this year. Okay. So if forget macro, forget earnings, forget anything else, liquidity remains just the most important driver. And I hate to tell this everyone, you know, how this flows kind of determines everything, you know, as long as they remain in full control and wanting to intervene at any given step when they feel uncomfortable, like they did in October, like they certainly felt uncomfortable in March, they can crank it up and boom, here we go. But what's happened since then, you know, a lot of this liquidity actually flowed into just a few stocks, right? And we got on top of the liquidity, we got a narrative, obviously AI. It's going to solve every problem in the world. It's going to lead to fantastic productivity increases. And boom, you had a combination of liquidity flows, underpositioned fund managers, bearish positioning on sentiment, both in funds and in retail. And now you get into the Isaac Newton reference that we made last time, which was, oh, you know, okay, so I made some money on the long side, and now it just keeps going up. It keeps going up. It keeps going up. And all of a sudden, just in this last probably 3-4 weeks, we've seen a complete flip in sentiment. What was bearish is now bullish. AAII, you name it. Fund manager positioning, which was really low, is really high. And everybody is chasing valuations, be damned, vertically up into some of the most overbought readings that we've seen during to like 2021 period, like it was key money printing. And ironically, if you're kind of a structural bear, this is ideally what you wanted to have seen, right? I mean, I came in from at the beginning of the year, said, you know, makes sense to see a rally in the first half of the year. And then if we get into the lag effects of the rate hikes into the second half of the year, then maybe there is that potential where things can actually roll over. Okay, that was kind of a premise, and it's an unproven premise. The first half kind of worked out. Now we get into the second half, and a really important point here. Lag effects typically, and people can argue about this, and no one knows with the precision of this, but let's say 12 to 18 months. Last June, we were still below a 1% Fed funds rate. It was not until June 19th actually popped for the first time over 1%. So we're in terms of lag effects, we're still in this very early period here of starting to see to filter that through. But the issue is, and this is something we all have to face, is, you know, this is so unclear in terms of when it actually hits. And I think the Fed actually has a problem because, remember, Jay Powell wanted to be all Volcker in August of last year and have this great tightening program and everything else. Well, when you have a NASDAQ with a 79 RSI, you don't have any tightening, you have monetary loosening through the roof, which is interesting because the Fed claims financial conditions have tightened. They haven't tightened. They've been loosening like wild this year. So having now reached some key technical levels with now superb optimism here into the summer, and the VIX absolutely crushed. And I should add one other really important component here, which is that's what I was alluding to for being different maybe to previous cycles. What we have this time is this massive gamified options complex with 0-day, 1-day options, which has a tremendous amplifying effect, I believe, in terms of the market action that we're seeing. When you go into record call volumes by far in small caps, in S&P, where those type of options all of a sudden make up the vast majority of the entire options complex, you get exacerbated moves, especially on an intraday basis, because I see it in the price action when it just goes vertical. There's no organic, okay, now I think is a good time to buy something. It's just completely vertical, and there's no two-way price discovery. And I'll finish up on this note. By this continuing to happen basically every week, Fridays, for example, is a classic day, except this last Friday when we hit key resistance. But by this happening week after week after week after week, people may be forgetting what they're actually buying, because at some point, maybe valuations, for a period, they may not matter, but at some point they do. When I see companies that are worth $1 trillion, $2 trillion, $2.5 trillion, $3 trillion, like Apple, almost at $3 trillion again, baking in valuations that would require many years of perfection to grow into. I mean, forget PEs for a moment, but I'll just mention forward PEs. I mean, Microsoft and Apple, they're sitting at 30, 34 forward PEs. That's rich in any type of setting for companies that are worth over $2.5 trillion. Wow, that's a lot of optimism. But go back to a very basic market ratio, which is price earnings growth, PEG ratio. Maybe I'm old school, but fairly valued used to be 1.0, richly valued used to be 2.0. Microsoft's at 3, Apple's at 4. That's a lot of optimism built in. So it's going to be interesting from my perspective now. I'll finish up on this note finally. This rally has gotten so vertical, so optimistic. It's now disconnected. What was disconnected in the October lows from key moving averages, we've now disconnected really high on the moving averages to the upside. And that's where you typically get into a point of rebalancing. And I think that rebalancing process that's coming is then going to be the deciding factor what happens next.
All right, that was a great intro. There's so many threads I want to pull from there. Maybe just to try to summarize everything you said, this is what I heard, where, Sven, you're a technical analyst. So that's the lens you primarily look through. But I know you also to be a macro analyst as well, and you bring that in. And what I heard you say is prices are now extremely disconnected from their key moving averages on the high side now, just as you said they were back in October on the low side. So you would expect some sort of reversion at some point just from that alone. You talked about this a little bit less, but I think I heard you say they're pretty disconnected from a fundamentals side right now when you're talking about just the levels of overvaluation, the key valuation ratios. Then I also heard you say there's been a pronounced sentiment shift, right? Bull markets climb a wall of worry, and I think that's more or less what we saw from October to now, helped by liquidity, which I want to ask you about in a minute. But now all of a sudden everybody's bullish or euphoric all of a sudden, and you're saying, okay, that's a classic market where a bear reversion, loves to come into play, where all of a sudden everybody's now, expecting sunny skies ahead forever. You're nodding as I'm saying all this, but am I correct in those sort of 3 big pillars that you see suggesting odds of a reversion being non-dismissible going forward?
Yeah, I mean, look, we went from a process of bearishness to capitulation, where I think a lot of bears have capitulated. We see that on the banking side as well. A lot of bank analysts have flip-flopped, not all of them, but some of them clearly have. We saw price targets being raised all over the place. That's part of the capitulation process. And be clear, I mean, I'm not saying, bears have any leg to stand on. Bulls are in full control here. just the fact that you are above all these moving averages, nothing has mattered at this point. They are in full control. And as long as the liquidity equation doesn't change, and we should probably tag on that a bit more as well, they're going to stay in control. In fact, I can give you some charts that are probably could scare the hell out of any remaining bear. I'll give you one example, is the Dow Jones. The Dow Jones, just kept holding its uptrend. There was this period where equal weight was horrifically lagging, as these top 10 stocks basically just vertically lifted everything up. And now you can talk about maybe the catch-up trade as tech is becoming really overbought. And you look at the Dow and you can make the case, well, here's a beautiful inverse head and shoulders. And guess what? That's pointing to new all-time highs, right? You can clearly make that case. If I look at the S&P on a monthly basis, you can look at the long-term trend. It never broke. That's what I was alluding to earlier. We had this bullish falling wedge. It broke out, and now it's above the monthly 20 MA. That was one of my key points. But my key point then was also not only getting above it, but then also defending it as support. And as long as that holds, bulls remain in control. And with that, you can go back to the yearly chart, which is where I talked to yearly 5 EMA holding as support last year and being defended. And maybe this is a brutal chart for bears in general, because it basically says we've been in a bull market since 1932. No, I'm serious. I mean, if you 1929 crash aside, where you had 4 years down in a row, and then World War II aside, which obviously was just obviously a historic event. If you go back to that, in the last 75 years, there's just been a couple events where there was 2 down years in a row. That was in the 70s, and that was in 2000, 2002. I mean, even the global financial crisis, it was just 1 down year.
Right.
And that was it. And then we had a temporary new low in the second year, and everything got rescued. And ever since then, it's been 1 year wonders, and off you went to the next few years of bull market. So that's why I go back and say, in the context of everything, bears had never shown that there was a bear market. And if you follow to the top trend line, you can make the case, 5,400 or 6,000, whatever, whenever it tags. And that was the end of it, right? If nothing matters, and they whenever there is trouble and they intervene, which they clearly do, then that's your bull case for sure. So,
all right.
now.
Just on that, let me interject, because it seems like such a core part of the bull case, and we could have had this discussion before this past year, is liquidity, right? I mean, the correlation between the markets and net global liquidity is super tight. I guess the question I have is what do you think of as the best measure of liquidity? It's such a prime driver of asset prices, but I don't know if there's like a universally accepted chart for it. And we're having this conversation. You're not the first one to mention this recently on this program, this liquidity sort of driving everything here. And I kind of feel like, boy, we should all wake up in the morning and just be looking at that chart, because it's really going to tell us what's going to happen. So what do you look at to measure liquidity?
Well, I mean, as in the last few months, I've been looking at bank reserves, because that's for now the absolute driver of everything. And unfortunately, we do not get the intention of it. We don't get it in advance. We get it on Thursday nights after market close, and it tells me what happened, right? Yeah. Let me back up a little bit, because this was presented as this great tightening cycle. And in terms of rate hikes being the fastest rate hikes we've seen in 40 years, it certainly seems very impressive that they finally caught up to that. And we haven't seen the lag effects. And I want to emphasize this again. We're all flying blind. Every bull, by the way, is flying blind on this, because everybody, due to the price action, assumes that nothing bad is going to happen as a result of that. I disagree. It will happen. The question is the when. In 2006, 2007, it took a year and a half. but then debt to GDP was 60%. Now it's 120% and
Mm-hmm.
going much higher now. Let's not kid ourselves. This Fiscal Responsibility Act that just passed to extend the debt ceiling, we're going to see a $2 trillion deficit again. We're going over $50 trillion in debt in the next 10 years. That's the path we're on. And so government spending remains extremely high, which also distorts everything because it's all counted towards GDP on some level. I mean, the spending remains there. But if you look at the monetary tightening cycle, I mean, just look at the Fed balance sheet and you just step back and you go, are they actually kidding us? I mean, the net reduction so far from in total is less than 7%.
Yeah.
There hasn't been much reduction at all. They pile in like wild. They piled in $5 trillion from the 2019 or 2018 low, and this isn't a matter of a couple of years, right? I mean, they just piled in like crazy, and now they're just ever so gently reducing with $400 billion thrown in a couple of weeks when they needed to during the banking event. They haven't really reduced liquidity in that sense. In fact, if I view this as all through, okay, has all this excess that was thrown into the system, has that actually been taken out? And the answer is no. I see people citing M2 money supply. It's true that the year-over-year change is dramatically negative, but if I look at M2 as an absolute, M2 money supply still to this day is 33% higher than it was just pre-COVID.
Yeah,
there's still just a ton of excess and liquidity flowing about, and as I said, with bank reserves, we've been on a net add basis to the tune of $500 billion this year. Where's the great tightening? The Bank of Japan is never going to stop monetary easing. That's just a fact. So if you're viewing an inflation fight through the lens of, okay, are we reducing excess? And that's, the evidence is simply not there. And so then you face the risk now with asset prices going vertical, that the wealth effect that you try to tone down is actually going to result in resurging inflation again.
Right.
Because if you look at total net worth, household net worth, it dipped a little bit last year in Q1 and went back up. I don't know, we're going to close the quarter in a couple of weeks, but because housing prices haven't really corrected dramatically either. If you look at the Zillow Home Value Index vis-a-vis the MBS holdings of the Fed, they have barely begun to reduce the excess of what they piled in following COVID. And lo and behold, house prices remain really high. Housing affordability is just dreadful. So there's really been no
worst ever for new home buyers.
Yeah. And so before you know it, you're close back to record highs in household net worth. And that's going to somehow solve structural inflation. I mean, yeah, there's all these year-over-year effects that are coming down. But again, is this going to solve wage inflation? Is it going to solve house inflation, rental price inflation on the long term? No. I mean, fact is, core inflation is at 5.3%. We were basically there in December of 2021. So what strides,
what progress have we made? Yeah.
Does Powell have to show here with an inflation target of 2%? But now we're in this phase when no one takes them seriously anymore. It was actually quite hilarious last week. Fed came out with, because they were in a box, right? Because if they raised rates again, they were scared of causing more banking hiccups. But they didn't want to sound dovish. So they wanted to leave the door open for more rate hikes. And so they put out this hawkish statement on how they're going to maybe do another one in July and maybe another one in September. and the market impact was not even 30 minutes because Mr. Powell came out and immediately basically put the kibosh on it, and markets went off to rally to new highs, to more easing financial conditions, because no one believes them.
Let me interject there if I can, because I two things. One, we'll pick up later because I know you and I can really get going on this. But to your point about the Fed, right now this rising liquidity is it is going to cause the wealth disparity to resurge, and it's really helping those who own financial assets right now, which, as you and I know, is 10% of the populace, right? So unfair on that. And a couple of years ago, the populace was getting some help. I mean, it's help that created this inflation, but they were getting checks, they were getting stimulus. Now that's gone, right? And cost of living has gone through the roof. Will probably continue to, as long as this liquidity surge continues. So you're helping the wealthy out even more, and you're hurting the less wealthy, the bottom 90%, disproportionately. So it's actually going to make that wealth inequality even worse than it was before. You're not, as I'm saying this, we can talk about that in a moment, because I'm sure we can, or near the end, because I'm sure we can rail about that for a while. But on the Fed thing here, where you're saying the market doesn't believe the Fed, the market hasn't been calling the Fed's bluff all year, right? Fed keeps saying, I'm going to keep hiking. Market says, no, we think you're going to cut earlier. And interestingly, the market's had to change its forecasts of the Fed pivot, but that hasn't really impacted asset prices. In fact, as we've been talking about, they've now recovered. They won the battle, and they're off to the races right now. So how many people say is playing for legacy here? I hear a lot of people say, look, don't underestimate Powell's conviction to do whatever he's got to do to get inflation under control eventually, even if that means sacrificing market prices and whatnot. And you've been saying core inflation, which is the Fed's preferred measure, has been sticky. So, and whether we believe the data or not, the jobs market still looks pretty robust. So that should give Powell a green light to just keep on taking the sledgehammer out and continuing to, hit the economy with more rate hikes and maybe more aggressive QT at some point. I'm just curious, what's your forecast there? Do you think Powell is going to have to ramp it up, and is he going to eventually say, markets, I don't care, what you want, I'm going to have to be the adult in the room and really do whatever it takes to bring this down? Or do you feel Powell's more of a paper tiger here?
Well, I would like to think that he would actually put the hammer on it, but he's revealed himself to not stick to anything time and time again. I'll give you one specific example on this press conference, which was, I don't know how you can take it seriously. He was asked specifically about rate cuts, right? And his response was, not for a couple of years. On the same day that the Fed put out a dot plot that shows rate cuts next year.
Okay.
Who am I taking seriously here? If he really wanted to follow through on this, I think he would have had the wherewithal, to be a lot more direct and more forceful. The fact that the market completely ignored him is a bit concerning, because you would want the Fed to have credibility. Problem is, you literally have 50 speeches each month where they're proclamating all kinds of things. Give an example. This whole June rate hike thing. The market had priced in a June rate hike outcome, Fed speaker after Fed speaker raising the expectations for a Fed rate hike, and all of a sudden they all flip-flopped and they took it back down to zero. So where's the sign that they're actually following through with it? Keep in mind, they're the ones flushing through the liquidity, right? With bank reserves and everything else that we've seen, yes, they're taking down the Fed balance sheet. By the way, QT is designed not to upset things, whereas QE is designed to stimulate things. So they haven't really shown this, and they themselves showing rate cuts in next year is not helping their cause if they really wanted to be hawkish. Now, I'm sure we're going to get now, if that's not the reaction that they wanted, they have an opportunity to rectify this week, because even Powell's speaking twice. He is giving testimony. So if that's not the reaction he wanted last week, then
They'll talk tougher, maybe.
Let's see if he talks tougher, because there's your answer, right? The other thing we all have to consider, I hate to get into the political calendar here, but there is a US presidential election coming next year. And Powell's not the ultimate boss here. It's Yellen. Remember Yellen? Yellen concerned about this, VIX dies. Yellen concerned about something else, the VIX dies. She's already announced a treasury buyback program to launch next year. Government buying treasuries before you know it. And that's specifically designed to improve liquidity.
So, okay. And so I just want to make sure we have this right. So right now she's having to refill the TGA, which technically should be draining liquidity. But I guess from what you're saying, you're not that worried. You don't see it changing the net flows, but tell me if that's wrong. But then she's going to shift next year and she's going to do a treasury buyback, which will then obviously add to liquidity.
So Yellen, to me, is obviously a key operative in the big macro monetary liquidity construct. And now that the treasury account got so low and they're refilling it, the view is, and that's been my view as well, that's actually going to impact bank reserves negatively. And a lot of the inflows that we're seeing are going to reverse, and they're going to pressure equities, right? So, and we have to watch this week to week. So what happened the first 2 weeks of June? They didn't barely reduce bank reserves at all. In fact, the first week, bank reserves went back up. Last week, they went down by about 25 billion. And maybe that's a red flag, because the first 2 weeks, they actually used the reverse repo facility, which tells me that they specifically wanted to avoid a negative impact on bank reserves. Because if dumb old me can see the relationship, so can they, right? And the question is, how far can they rely on the reserve repo facility? I mean, the numbers are staggering in terms of what they have to do to refill the TGA account. And we're talking $1 trillion and a half dollars. I did mention a $2 trillion deficit coming this year, right?
Yeah.
So there's a ton of funding requirement, and if this actually does translate into significant reduction in bank reserves, and you can argue this refill of bank reserves going north, starting in January, was largely, or I shouldn't say largely, but largely impacted by the drainage of the TGA account. And if we now do see them not being able to refill all this vis-a-vis reverse repo, but they have to redrain bank reserves, then you can find yourselves in a situation where all this, what we've seen here in terms of the market rally, was the grand illusion, because it was liquidity filled, and because price was so aggressive and persistent that it resulted in a complete flip in sentiment. Then it would have been your classic bear market rally bull trap. And you can argue that maybe the options complex with 1 day, 0 day options just amplified it all.
Yep.
Okay. And that's the process of discovery we have. And I found it actually in this context curious. Yellen was asked about the TGA account the other day, and she was oddly specific, which she said something which I was surprised why she even said it, because it wasn't really necessary to say it. But she said they're going to add to refill the TGA account in June and in July, and then maybe not in August. So she gave a rather specific roadmap for that, which, to the extent that that means that bank reserves are going to drop, if they are, then you have a window for market weakness even into July, which is not typical, right? Typically, right. July is fairly positive. And then things flip-flop again in August. So hard to say. I mean, we're trying to trade technicals, we're trying to trade the signals, but we are, whether we like it or not, we are beholden to the liquidity equation. So this is a big issue as it pertains to markets. I mean, from my perspective, let's be absolutely clear. This market rally that we've seen, liquidity fueled or not, is all multiple expansion, massive multiple expansion. I mean, Apple making new highs, great, but it's doing that on slowing revenue and earnings growth. I mean, that's what you have in this year, right? And if you're bullish, you say, well, the worst of the decline is over. Okay, that's a bold argument to make, knowing that we haven't hit the full lag effects at all yet, that wall is still coming, right? We haven't seen the full effect of tightening in lending standards. This is the hard part this year, absolute hard part. I called it flying blind earlier, because none of us know when and where and how hard it's going to hit. Philosophically, I can say, well, we've tripled debt since 2009, and now we've got the highest rates we've had since 2006, and you're telling me it has no impact whatsoever. That doesn't inherently make sense to me. But then when I look at, again, liquidity in terms of M2 and the balance sheets and mortgage-backed security holdings and so forth, that haven't really been reversed in any major way, I get why we got risk full on again. So the animal spirits, they haven't been extinguished at all. I mean, that's typically what you would see in a bear market. People puking out their positions and capitulating, and everybody hates stocks forever and ever and amen. But that's not what happened here.
Right. We didn't get anywhere close to that, I don't think. So
there was no panic. There was no fear at all. Let's go back to my lower highs in VIX. It was lower VIX than in 2021. It was ridiculous.
Yeah. What did you call it? You called it like the most controlled market decline or whatever.
Most controlled bear market ever, but it wasn't even a bear market.
But it wasn't a bear market. That's why, by your definition. So I was trying not to use that word exactly. So yeah, we never saw the panic.
No.
So
because they intervened very subtly by changing the liquidity. No.
So let me ask this. So the economy is not nearly growing by as much as the markets have this year, right? Which is why I believe you said it's all multiple expansion, right? That's the liquidity just pricing, making things get priced ever more richly. Thinking about the economy for a second, and I just want to dial into the lag effect, because you mentioned it a number of times here. So I sort of think about, imagine a building with a side elevator on it, right? And the Fed is standing on the roof of the building, and it's looking at the side elevator rise. And let's say the economy is the side elevator, and it says, you know what, it's rising too fast, right? So I'm gonna do a rate hike, which is the equivalent of releasing an anvil off the side of the building to land on top of the elevator and slow it down a bit, right? And Powell decided, you know what, that elevator is rising so fast, I'm going to throw more anvils. That's what last year was, just chucking a bunch of anvils of different sizes over the side. Now they're in their progression of falling, right? That's the lag effect. We don't know how many have actually hit that elevator yet. Our guesstimate would be probably not that many so far, if the true lag is 12 to 16 months or whatever you said, right? So in theory, that rising elevator is going to get hit by more and more and more of these anvils, even if the Fed pauses from here on out, right? And so a big open question, this is sort of why I think you said we're flying blind, is we don't know what the net impact or the net effect of the impact of all those anvils are going to be as they hit over the coming quarters here. That could really slow, it could stop the elevator, right? And that's the problem with the lag effect is if the Fed is over tightened, that elevator may stop and it's going to keep getting hit by anvils over time. Could make a pretty bad situation worse. We just don't know. And maybe, I'm just guessing here, maybe that's why Powell is pausing now, but keeping the door open for more rate hikes, is he's maybe got more confidence that the market does, that lag effect is going to make a difference. Who knows? But the other element we have here, so that's the economy, right? And in theory, the market should be based off of what the economy is doing, right? If it generates X amount of earnings, well, then the markets should react to that. You're shaking your head because what really matters there is the amount of liquidity, right? So we have this weird world where the economy could really stumble. Yet markets might not if this net liquidity just keeps rising. And I will say there's a ton of bears who are scratching their head coming into this year. And I'll be honest, I was one of them. We could see, okay, monetary stimulus is over. Fiscal stimulus is declining in terms of just what Congress is being able to get passed, at least. And we have these rate hikes, and we have QT, and we have the banks tightening lending standards following the banking crisis, and all these things, that, the TGA having to be reflected, all these things that you think would be net liquidity contractors, but they haven't been. So as a nervous bear, you got to be thinking, oh my God, well, when times are good, I mean, or what are these guys going to do in the future for more liquidity? If this was the bad liquidity, oh my gosh, the not so bad liquidity is going to be like ponies for everybody.
Well, first of all, again, $2 trillion deficit, I would simply say that's stimulative.
That is stimulative. It is.
I mean, look at construction spending. I'll give you, that's another argument for both. If you think there's tightening going on, no, it's gone vertical. A lot of it has to do with the packages that were
the Inflation Reduction Act, all that infrastructure spending. Yeah.
Right. Massive infrastructure spending. And so that's stimulative. So don't anyone tell me there's not stimulus running through the economy. That's stimulative. Okay. Deficit spending is stimulative. I mean, typically, you get the big deficits when there's actually a recession and they need to stimulate. I mean, if you're running a $2 trillion deficit during a non-recession period, what are you going to spend when the actual next recession comes? And by the way, I'll be clear, we're all working with fantasy numbers. All right. I mean, this deal, that ceiling deal that just got passed based on CBO projections. I'm sorry, just don't ever intellectually insult us all, because all these forecasts, all of them are based on no recession ever, just always continuous positive GDP growth. And I look at net interest expenditures on debt is already outdated in the first year. You just got to realize that the real math effects of what's happening with higher rates for longer will have a dramatic impact on the sustainability of the debt construct, because all this debt is rolling over, will have to be refinanced. Not only the $2 trillion they're going to have in new deficits this year, it's all the rolling over debt that came from cheap rates this year, next year, going to have to refinance. I mean, interest and debt's going to be over $1 trillion this year. It's going to go higher unless they cut rates.
Right, which is constrictive. That's not liquidity.
No, it is, and this is the thing with also the labor market, that everybody is having a positive view on at the moment. That's what always happens. The labor market is the last to go, and that's why I'm a little, I'm not too keen on the data points that we're getting with all these seasonal adjustments, because I can't see what's real and what's not. I mean, on the one hand, I see ever more layoff announcements. On the other hand, I see a 3.4% unemployment rate. Also, although it just ticked up to 3.7%. But the fact is, labor market's still tight. You got a lot of people. Unfortunately, people are passing away, and so there's wealth transfer going on. So there's still a whole wall of monetary stimulus coming in the next few years. I keep going back to this whole notion of how are you going to beat structural inflation? Yes, the event inflation part is over, but the structural part, the traditional solution was a recession. It was not, the next bubble forming and off we go, which is kind of where we are. If I look at the valuation expand. I mean, when I say people are piling in, they're piling in. I mean, Microsoft, which is a great company, and obviously they're now one of the key AI players out there. But when I see a market cap expanding by $500 billion in less than 2 months, that's not only a lot of revenue that ultimately has to come in, but that's just enormous amount of earnings that has to justify that. So, and with the VIX again completely collapsed to 3-year lows, there's just no fear in the market at this point at all.
God, there's so many things I keep wanting to ask you about, and I'm trying to be as silent as possible and let you talk because you're doing such a great job. But I got to interrupt you on the VIX. So, is the VIX even a useful metric at this point?
I think this is a really fair question that I have to acknowledge. I think it may be broken. I mean, a lot of people are considering it broken, and for good reason. The impact, as I mentioned earlier, on the options complex, it's so dramatic in how it's colored. I mean, recently I've seen days where it doesn't matter what the VIX does. It goes up, the market goes up. It goes down, the market goes up. You would think that at some point when you see the most obvious program on the planet, which is, i.e. VIX Crush Fridays, if too many people see it, it becomes itself a useless indicator, and ultimately even becomes a trap. I mean, we've seen this before with the VIX. There was a few years ago, there was an ETF product that blew up in everybody's face ultimately. It seems to me, with the valuation and the technical disconnects becoming so vast, that this incredible low volatility that we see is ultimately conducive for another big rip higher that no one sees coming at the moment, and then maybe no one's positioned for it. I mentioned record call volumes. I mean, this is hardly any demand for puts at all, and they're really cheap. The boat is very much loaded one way, but you also have to be cognizant. Beating the VIX below 20 and now into the 13 range, this is the time periods when you have confirmed new bull markets. Remember, in 2017, it just dropped to 10, 11, or what have you. But I'm definitely.
I went short the fangs for a little while during that period, and boy, that was just terrible.
No, I mean, there's the old phrase, markets can remain irrational a lot longer than you can remain solvent, is the phrase. And I think the emphasis here is on irrational. So if you think that markets are forward looking, well, they weren't so forward looking in January 2022 when everybody was proclaiming 5,200, 5,400, whatever on the S&P. No, it's liquidity, and unfortunately, we're all subject to it, and we're also then subject to shifting narratives as price then moves in a different direction at some point. My view has been for 23, we just got to be respectful of all possibilities, but we got to be also mindful of shifting risk reward. Okay, I mean, I was bullish October lows, bullish January, bullish in March when the SVB thing happened. Now I'm having a real rough time, to be honest with you, justifying any new longs. Tech's been going vertical now for weeks. That's, to me, is kind of not a good. I mean, weekly RSI completely outside the weekly Bollinger Band, back to the March highs from last year, super extended. I can't justify new longs on tech here. So to me, that's kind of an initial corrective type situation. On what we have been doing is looking at small caps and the Dow Jones as long plays, because that was kind of the catch-up trade, because some indicators were clearly oversold. Even though we did not have a single larger correction in May, we got oversold indicators because the larger market was correcting while the indices chopped in May. Remember that chop period that we had for about 6 weeks or something like that.
That was the battle for control.
That was definitely a battle for control. And now that we've broken to the upside, tech's gotten even more overbought. But there've been opportunities with the down. I mentioned this potential inverse. It hasn't confirmed, but it could play. One of those things you want to see validations. Small caps, I have to say, actually, there's a lot of financials in small caps, and maybe worth looking at a larger chart of the banks, BKX, because as I mentioned, the October interventions actually came at an opportune time on tech, because that was the point where it looked like everything was going to break trend. And guess what? In March, banks were looking to break trend, and that's when the intervention came. And if you look at that chart, though, there is a bounce, but it's really tepid. And I think this is maybe want to accentuate the potential bear case here, because this all sounds like bears don't have a prayer. And yes, if I go to 2006, 2007 example, we're going to hit new highs before anything bad happens, right? If the lag effects take that long. But if I look at the banking index, it's barely bounced. The recent rally here in June barely bounced. I mean, if you think you can have a sustained bull market without the banks participating, you're a lot braver than I am. So I'm not sure that this is a positive sign. And the second thing I want to highlight here is rates themselves. In 2022, if you look at the NDX vis-a-vis the TNX, now on this chart here, I have TNX inverted. So you see the relationship clearly outlined. So if you're on the chart seeing TNX going up, it actually means it's going down, and vice versa. Meaning that if you have higher rates, it impacted tech negatively. That's what happened all of last year. And it was then in the fall time frame when the 10-year actually peaked. That's when you found a bottom in markets in general. And since then, we've had a big reversion in yields, and that was supportive of the tech rally. That was supportive of the overall market rally, because from that perspective, you can argue that was the peak in tightening, right? Again, higher yields matter. And yet something really weird happened this year. And that is, it's another one of those relationships that got totally blown out of the water. Because yields actually have been rising, and tech has completely and utterly ignored that. And I have a hard time reconciling this from a fundamental perspective, because tech does not like higher yields in general. Tech's been living off low rates since the 2009 lows. Yeah, rates go up, doesn't like it. That's why we had the hiccup in 2018, right? Because they were actually raising rates.
Yep.
Now rates have blown far beyond that. And if you look at the TNX weekly chart, I did a little Northcast on this a while back. It is actually confounding that chart, because it's looking like a gigantic bull flag. And I have a tough time reconciling that with everything I said before, about maybe the Fed not following through, what have you, because if that's a bull flag, and it's so clean, it's as clean as the chart was last year with the S&P going down, and maybe it's related to the refilling of the TGA account. I can't say, but this chart says higher yields. I'm not sure you can sustain a rally indefinitely with higher yields coming. So I think this is a really important chart for everyone to watch. Yes, it's been ignored. And maybe the liquidity that we referenced earlier has allowed everyone to ignore that. But the 10-year is back at 3.8%. Last year, when the 10-year was at 3.8%, no one was happy about that. The 1 year is massively over 5%. And all of a sudden, you're looking at a reality where earnings yield is dropped to the point where, from an investor perspective, you get the same yield.
Why would you take the equity risk? Yeah, exactly.
So do I want to take the equity risk with valuations sky high, markets having massively recovered, and the VIX at 13? I wonder. And then you get into the issue of, okay, last year we had the worst bond equity performance ever, the 60-40. And now you have kind of a mismatch here going on. and you're looking at the end of the quarter, and you have to wonder, okay, what is the task by pension funds? Remember, a lot of this is not a choice. They have standards to meet, balancing standards to meet. And now I wonder, and I'm speculating here, but I'm wondering if we're going to see some rebalancing as a result of this relationship all of a sudden. And
meaning selling of equities, buying of bonds.
Why take the risk at this point in the cycle, just in front of lag effects? After a big, massive rally. Now, having said all this, I go back to what I said earlier. As long as the monthly 20 EMA on the S&P holds bullseye in control, bears have to drop below the monthly 20 EMA, and they have to drop below the quarterly 5 EMA. You do not have a bear market at all. And on any retrace, and this is also important from a technical perspective, now that we've ripped this high vertically and gotten this overbought, there is a typical, probably very frustrating for the bears event. That means if you get an initial pullback, 5%, something like that, and you reconnect with some of these MAs that are currently disconnected, you're going to be oversold really fast. So my barring, an overpowering liquidity reduction in bank reserves, which may happen, I can't say that they won't, but barring that, I would suspect that the first corrective dip will get bought. Not only because of technicals, but also anyone that's missed the rally will want to get on board, right? And so let's say you get a move back to the 50 MA on the S&P or the NASDAQ, which these would be sizable reversions all of a sudden because we're that far disconnected, right? But I'll just throw this out as a hypothetical. If you get that, you will likely see a bounce from there, see a rally. And then what happens next is going to be, for me, the key decisive point. Will that result in new highs for vis-a-vis what we're seeing now, or is this going to roll over for a lower high, and then we see actually the lag effects taken over? And I go back to a chart I mentioned, I think, at the tail end of our last discussion a few months ago, which was the S&P seasonality chart. And for all the things that we just discussed, it is hilarious in a way because it's still playing. And that chart had a March low and a June peak. Guess what? We had a March low, we had a June peak, calls for a little dip into the end of June, and then more highs in July. And that chart basically says game over for bears this year. Maybe get some another correction in September, October, but they're just going to keep at it. So for all the complexities out there, they're also, standard workings through the market that may well extend us still into next year, especially if liquidity keeps flowing. So I would say this has generally been a very maneuverable environment over the last year and a half. But now we're getting back to a point where credulity is kind of being stretched again because of the belief that suddenly nothing bad's going to ever happen again, because nothing bad has happened, right? And that's the challenge here. Technically, I can't buy convincingly here now. I can make a technical case for buying pullbacks, but I can also still make the case for a major rollover to come. The question is the when, and that's the unknowable at this point. I would just say, generally speaking, nothing has been cleansed. The monetary excess is still in the system. Valuations are still sky high. In fact, they got just brutally more expensive. I mean, you're looking at almost 20 PE again on the S&P. You're looking at the leaders of, the AI club obviously being through the roof on that basis. So, I would say as long as the labor market's holding in, I think bulls will want to continue pressing on dips. But once you see the labor market rolling over, remember the historical script. Structural bottoms happen not when the Fed pauses rates, but when they're panic cutting. because then something will have broken.
All right. So, Sven, listening to everything you've said here, it sounds to me like you are a pretty solid bear fundamentally, but you're a technical analyst and you're looking at the TA and you're looking at the effective policy decisions, and you're saying, man, I mean, they can keep this thing going for a lot longer than the bears can imagine here. So I got to presume that this is a more challenging time for investors. You know, you've had a long seasoned career. Is this true? Is this, or have we entered again yet another kind of on the metrics of easy and hard, the hard part of making investing decisions at this point?
Yeah, Tim, you know, speaking about, you know, how far this can go. I mean, this is the way I've, you know, there've been times when I've been fighting the tape brutally when markets are indeed irrational, and I've learned a few tricks along the way as well. You got to be so respectful of the strength, and we went from conviction long to cautious, now trying to position for fade, but always every week we're finding a long entry because of the persistence in the tape, and we're looking where we can justify that at least, right? I mean, again, from a technical perspective, new longs here, conviction new longs, to me does not make sense. It may well make sense in 2 weeks, you know, if we get a nice pullback or something like that, or next month. It's always a balancing act between net long and net short for us, and the risk reward from my perspective vis-a-vis October has clearly shifted at this point. But you got to be respectful of the strength. And I said 2006, 2007, you know, they paused rate hikes and markets went off to make new highs. And I can even use 1999, 2000 as a reference example. Why did we have that blow off top in the NASDAQ in 2000? I'll tell you why. Because the Greenspan back then added a bunch of liquidity. Why? Because there was a bunch of fear about Y2K. It was not until that liquidity got pulled out that the NASDAQ completely collapsed on itself. So I hate to say this, from cycle to cycle, the Fed folks have their fingers in the liquidity pot, and they are massively impacting how markets flow, whether we like it or not. And so, you know, you can argue with the market, or you got to be respectful of the powers that be that are involved in it. I mean, you mentioned me being bearish on the macro. I can certainly say that I see massive recession risk, but even historically, I can say this can take a while to play out. But as we saw, and I'll give you one other reference, a lot of what we're seeing this year is kind of reminiscent in a way of what we saw in 2008, right? SVB, same weekend as Bear Stearns. What did we see in Bear Stearns? Massive intervention. And we had a massive rally. And everybody was happy again. Back then, Bear Stearns, that rally petered out in mid-May. And then it was lights out. This time, it hasn't petered out in May. It continued into June, right? And back then, we were below the key moving averages. Now we're far above. So you can make the case it's not the same. But I'm just saying, in terms of script, where people think, okay, now things are much better because nothing bad has happened and they saved the day. Well, that has happened before. This is the most uncomfortable thing for me right now, is the flying blind aspect that we talked about in terms of the impacts. Now, if you're not concerned about, you're not concerned about flying blind, you just pile in, right? Because nothing bad's going to happen. But that's what happened in 2008, right? Because the economic impact was felt, and it will be felt here as well. And now the Fed basically has said, well, we're not, again, they're going to say we're not going to cut this year. And in a way, that's bad news, because that means the lag effects will ultimately be more powerful, right? You would want to see that inflation fight having been won. But the reason the inflation fight hasn't been won, in my view, is that by having induced that much liquidity and wealth effect again, they are actually delaying their own victory, which forces them to be higher for longer. In the most debt-laden economy ever in any of our lifetimes. So you overtly risk that something does break out of the blue and the equation changes. So to be completely complacent as this market is right now, greed indicators through the roof, everybody bullish now, having seen that sentiment shift, all these people that were skeptical piling in, well, who's going to save the day when this thing goes down? Because you don't have a lot of these previous shorts to cover, right? There are still shorts out there. Commercial speculators definitely are. And they're actually been adding to positions in the last few months, which is interesting because that's also what they did in 2007. They looked horrifically wrong, but they were ultimately proven terrifically right in a bad way, right? So this is a complex journey. I would not be blasé about it, but you got to be cognizant of the risk.
All right, and this is where I was going with saying this is now on the hard side of the investing scale, where it's difficult to navigate what's going on here. All right, so two questions for you. First is, we've got regular people who watch this channel and they are just trying to navigate what's going on, hopefully not become collateral damage to anything bad, and to try to at least make some money with a relatively acceptable risk return ratio if things go well. What would sort of be some of your parting advice to those folks? I heard you say, like, all right, don't go super long into tech right now, maybe buy on a pullback, wait for a pullback to buy. If there's a pullback, if you're bearish, don't pile in immediately because that's likely to get bought in the near term. What other bits of counsel would you give them?
Well, first of all, one of the things that was missing, by the way, in May.
Our interview with Sven will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. Finally, if the challenges Sven has detailed in this interview have you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks and opportunities that Sven's mentioned here. Just go to Wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Sven Henrich.